Do you want me just to give a quick introduction to what happened? Or, God, I don't know how long you've got.
When you get a major crisis, there's never one specific cause.
You could actually see some of the people exiting that Lehman's office with boxes in their hand.
Being an entrepreneur is not as glamorous as it may look.
After the financial crisis, it was very clear that customers had lost trust in the banking system.
One of my co-founders told his boss he was quitting Deutsche Bank to run a startup, and it was laughed at.
People told me I was crazy.
Our ultimate goal is that there is no more fintech.
Could the financial crisis have been prevented? Yes, it could have, but actually, we've benefited from it.
One shot, now the future is yours. Go! Taking over pieces and shares of all big sky high. Check the movement is here, yeah. I'm turning dreams into reality. In the lab with the formula and chemistry. Your memories spark and motivate and make the industry shake. We put the bars in the brakes. I'm talking one. Yeah. It's one shot, now the future is yours. Go!
So it's been 11 years since the financial crisis, and it feels both probably like the longest 11 years of my life and the shortest at the same time, which is really odd. But I think an amazing amount of stuff has actually happened through that period. We've seen big organizations start to really change their strategy. We've seen new organizations, new fintech players really come to the space. Even fintech wasn't a thing back in 2008. You know, we've seen massive regulatory changes happen both in the UK and globally. But I guess let's roll it back to 2008. Where were you guys?
I wasn't working in financial services. I was doing a consulting gig for a corporate client. So it was one of those things that was in the background. You kind of saw it on the news. You saw, some big bank you'd never heard of is started to crash, or suddenly there are people queuing up outside banks. What's that all about? So it was this slow thing from a consumer perspective. But then really, I think people started to get worried.
Yeah. What about you, Simon?
I was jobless. I'd just taken a voluntary redundancy. Funnily enough, I don't think it was because of the crash. I remember seeing the crash and thinking, this is interesting timing, and it will come back. There'll be a moment where you remember this. And I think I learned more in that year than I had in the years previous. So had a lot of fun with it, weirdly, learned a lot of skills.
Had a lot of fun with the financial crash.
Yeah, no, I did. Turns out it wasn't bad for everybody. I think there's something about a crash and a recession can create opportunity.
I mean, as for me, I remember vividly, the day that it all sort of unfolded on the BBC news channel, sort of sitting back from my desk and being like, well, good time to get into banking, David.
Crap.
I actually had ringside seats to the global financial crisis. I was part of a private equity firm. So while my offices were on Park Avenue in New York, literally 47th and Park, and Lehman Brothers was like 2 blocks away.
I was a policy advisor and press secretary on the Obama campaign in Pennsylvania, but I was participating in the campaign while on leave from my law firm, Sullivan & Cromwell in New York. So I found myself fairly caught between the private sector reactions and all that was going on Wall Street in the lead up to the crisis and what was happening in the campaign scene.
So I was doing the normal sort of work that any professional services consultant does with their banking clients when all seemed plain sailing.
So I was actually just about to start my first graduate job here at the Bank of England 11 years ago, and the graduate scheme started 2 weeks after Lehman Brothers went down.
I have a lot of friends in investment banking, and going to the pub with them and having a few drinks, the more they drank, the more explicit they were about how worried they were about their jobs, about the economy, about their investments, how they were moving their money into savings, and they recommended we did it too. I've distinct memory of being in the pub with one particular friend where he was adamant that I should move all my money into gold overnight.
I was sitting next to a very well-known director of a big bank, and he and I were discussing the financial services industry over dinner. And he said, oh, it's only it's only going to last a couple of weeks, then it'll all be over.
My main memory was I was on holiday in Bosnia on a walking trip, and a few people on the group holiday came in and said, "Victoria, do you know the queues outside Northern Rock?" And I came back a few days later and was sort of called into the bank and was very quickly put on the team involved in the resolution of Northern Rock.
I remember sitting on the subway and watching so many people coming out with their boxes, having been let go or the company shutting down. And I remember thinking that this is really impacting the people on the street. And for the first time for my generation, you felt this significant shift and a downward trend or a downward feeling about what might be coming up in the future.
I remember actually trying to explain to my daughters that we had failed them because we had allowed the wrong kind of financial innovation to take place from right under our very eyes.
I joined a group at Resolution Capital, and we were looking to use public markets money to make big investments in the European financial landscape, frankly, to take advantage of all of those large banks that were selling their crown jewels at the time at knockdown prices.
So, guys, what actually happened?
I mean, I'm not going to probably do it justice in the way that Margot Robbie did in The Big Short, so bear with me here. But I think the fundamentals of what happened was the system just ground to a halt. The liquidity in the system actually stopped moving around the system.
Banks create money that then lubricates this massive national, international machine, but it's all predicated on not everyone suddenly losing confidence and wanting all of their money back. Because if they do, then the machine grinds. There's no lubrication. Suddenly the wheels collapse. And that sort of confidence that keeps it all flowing suddenly solidifies, and who's left, with the money, who's left without any money, and suddenly there's people who need that to survive.
And what's crazy is once the confidence goes, how quickly that sort of domino effect comes. And confidence is such a sort of ethereal quality to it. Like you feel like somebody somewhere has got a spreadsheet and knows the answer and has done the calculation, and it's maths, and it's not, it's human sentiment. It is confidence that's a really, really odd thing. And then you think about a person in the street looking at that and their confidence in the bank versus the people in the banks lending to each other and their confidence. It's got different layers to it.
Yeah, I think fundamentally it was like this weird big game of sort of musical chairs. The music stopped and there was a lot less chairs than we thought there were.
Oh, I think the causes of the crisis it's potentially an endless list.
It's always hard to draw back to, okay, what are the real drivers behind this? And there's so much else going on, it's hard to narrow down on what was a real problem back in 2008.
When you get a major crisis, there's never one specific cause. There's always a combination of factors. There's underlying issues that have been around for some years, and then there'll be a trigger point.
Really, we had a coming together of pretty much a perfect storm. I think what no one was predicting was the severity of how those events would come together, and indeed the impact that it would have on certain sections of society.
Tens of thousands of people out of jobs, out of work. And the impact, of course, that had on them and their families and their relatives and everyone dependent on that. And the supply chain, right the way through to, real estate and the people that bring the sandwiches in for all those fantastic meetings. And then their families. That's a huge consequential impact.
Often we would see letters about people struggling to keep their homes or who had lost their homes, trying to make ends meet after having lost their jobs, trying to afford sending their kids to college. So the impacts of the crisis were really quite long-lasting.
The question is, whether or not at the time the Fed should have done more to support layman's, and I think the argument could strongly be made that it would have been better for them to step in and not let layman's go.
It didn't have to fail. And when it failed, it then created a knock-on set of consequences that were impossible to predict.
It was very hard to understand as to why a event in a place has had such a big impact on my life, my economy, my job, my savings rate, my mortgage rate. Why did all of this happen?
The reaction of the regulatory authorities and the government when the real disaster happened was, I think, pretty good under the circumstances. Arguably, before then, the Bank of England perhaps had been a bit slow to recognise the nature of the problem, And certainly, if you read all the accounts, there was tension between the Treasury and the bank. But once the real crisis happened, I think the authorities did the only thing that they could have done, and they did it pretty well.
I think the first move came out of the US, and I think the Obama administration put austerity to one side and said, we are going to inject a significant amount of money and capital.
Gordon Brown and Alistair Darling, who were the Prime Minister and the Chancellor at the time, they took some immediate actions which actually prevented this to spread further, something that could have been a lot more catastrophic.
In order to bail out the banks and the financial service industry, we had to have quantitative easing. That issues more capital into the markets, and the idea is that capital goes into the markets and eventually finds its way through to the consumer.
And so this set off both an unprecedented recovery in the longest bull market in history, but had a number of consequences, particularly around how banks focused on their own stability or liquidity and lending.
It was very much in the gaze of the media. We knew we needed to get that right, but similar discussions were going on right across the world. I think in total over the financial crisis, about $15 trillion was spent sort of trying to save failing banks, just because of their importance to the financial system, but to the economy more generally and to individuals. Ultimately, there was sort of pretty much a global recession. We did see people losing jobs. And so I think since then, one of the key things has been to rebuild confidence. You need the financial system to be there. You need it to lend to businesses, but it needs to be done in a safe way.
Trust in the financial system took a real hammering in the financial crisis. It took a long time to build that back up. As a result, people were willing to try other providers. So whether it was the growth of alternative or peer-to-peer lenders, there was a shift away from traditional banking towards new providers, and that offered an opportunity for fintechs to step in.
I could see what the banks are ignoring in terms of the customer experience, in terms of the value. I want to go off and create that business.
My name's Giles Andrews. I was one of the founders of Zopa back in 2004 and currently sit on the board. The credit crisis that hit the world in 2008 was an incredibly significant event, obviously very broadly, but also directly to Zopa. We were seeking to give people a better deal by effectively cutting the bank spread. If you think the bank spread is the gap between what banks pay their savers or depositors and what they charge their borrowers. In the run-up to the crisis, that spread had been artificially compressed. And it had been compressed for two reasons. One, banks were doing silly things, which ultimately is what caused the credit crisis in the first place. But also they were using the sale of a product like PPI to cross-subsidise the price of loans. A bit like Tesco's will sell milk very cheaply to attract you into the store so they can sell you some expensive organic tomatoes. Banks were selling loans in many cases as a loss leader to create a customer to whom they could missell, forgive me saying that, a PPI insurance product. So when the crisis hit, a number of things happened at pretty well exactly the same time. Firstly, the Bank of England cut savings rate effectively to zero. And normally when you cut interest rates, you'd expect the rate at which people borrow money to go down as well. Maybe not quite so much, but you would expect it to follow the reduction in base rates. But it didn't. Personal loan rates actually went up. And they went up for two reasons. One, because banks were very short of money, so they had to reprice the loans more expensively for them to be profitable. But also, they'd lost the ability to sell PPI because it got banned. So actually, as savings rates went down, borrowing rates went up. So the spread between savings rates and borrowing rates increased, and therefore our job became an awful lot easier. Suddenly, it was easier to offer our investors a better return than bank savings customers, and it was easier for us to offer our borrowers a cheaper rate than they could get from a bank.
Times that are difficult often create the opportunities if you can see through the obstacles and what the opportunities are.
I don't think as much money was spent by the government here to invest in the economy versus in comparison to the US. And I thought you had two very interesting examples of how two countries handled the situation in a very different way.
Could the financial crisis have been prevented? Yes, it could have. But actually, in some ways, we've benefited from it.
regulation has been seen, I think particularly at that time, actually kind of a good excuse for why you can't go and do something interesting, which I don't think has ever really been the case, but it's definitely the excuse that many organisations have sort of put forward. But I think at that moment it really changed in terms of the sort of approach to regulation.
But what was interesting here, I think, following on, and especially in the UK, is that the regulator not only put in place even more sort of a straitjacket around what was allowed and what wasn't, but actually started to look forward and say, well, actually, maybe one of the problems here is that there are very few of these very large banks, and they're all not doing very much. There isn't the innovation, there isn't the sort of driving things forward. So maybe more competition creates a healthier environment, which actually then reduces risk.
There was an immediate reaction from the regulator to say what needs to be done in order to fix the problem. And there was also an appetite to really understand how financial services worked at a higher level and say, where can we change things to make it more democratic or more inclusive?
Globally and indeed domestically, I think there was a movement that said we can never have the kind of set of circumstances that came together in 2008 happen again. And a real determination from regulators, whether that's in Europe, whether that's in the US or other parts around the world, to say, can we strengthen the system? Can we make sure that there is real clarity about what is happening under the bonnet of financial services? It's fairly common in the UK for sector regulators to have the same kinds of powers as the main competition authorities. And financial services at the time was maybe a bit of an exception to that rule. What it means for us is we have the ability to use competition tools, in other words, the ability to look at the underlying structures of markets, to think about how competition is happening, and indeed how innovation can be fostered.
At the time, the Conservative government under David Cameron and with George Osborne as the Chancellor really had a very important policy in giving the FCA the competition mandate, which is really, I think, probably the only regulator in the world, or maybe one of two that has a competition mandate. And that's important because in addition to its job as a conduct regulator and protecting consumers' interests, it has a secondary objective of making sure that there's competition in the best of consumers' interest in the market. And this is a pretty complex job, but I think it's a pretty innovative mandate for a regulator to have.
That competition mandate comes from a convening of forces. At the same time, you had, I think, a government that was looking to create competition. That was their political persuasion. And you had a bunch of policymakers who typically were a bit more flexible than you would see on the global stage. For instance, there is an example of a rules-based regulator, I think it was in the US, that had a rule that said you must use a fax machine for a particular type of contract. But in the UK, you would historically rely on a principle that these sorts of things must happen in this contract, and the technology you use is kind of up to you. So a competition mandate for something that's a bit more flexible as a framework was really, really powerful.
So it's a bit more sort of shades of grey then. So it's like the offside rule in football. You might not quite understand it, but at some point the referee's going to blow the whistle, right?
Pretty much exactly.
The consumers should have a range of choice and quality when they go to market to be able to find something that suits their needs. And so competition is an incredibly important part of what we do in enabling consumers to have that choice. But what we could also see is a common misconception that regulation was somehow bad for these new small firms.
There's a concept of an immune system within an organisation that when you introduce new ideas, the immune system will instantly look to reject the idea. It's the same in pharmaceuticals, banking, healthcare. It's not a new phenomenon.
So one of the things we did as the Financial Contacts Authority was set up something called Project Innovate. And what that was about in its early days was really making it easy as possible for those innovative firms to come and talk to us, to dock them with existing regulation where we could, but also being open and prepared to say we would change how we regulated if we did see ideas that were in the interests of consumers and we needed to shift our rules or our policy approach towards them.
There were important things that were happening structurally here in the ecosystem that all really started to drive the incentives for innovation and greater participation of fintechs in the ecosystem.
So I really got involved in fintech sort of 2014-ish. I'd been a consultant for much of my career, and right back in the early days had worked for Anne Bowden when she was CIO of Aon. Fast forward 15, 20 years, I think she visited my LinkedIn profile and we ended up meeting in some hotel lobby, and she pitched me this idea that she was going to start a bank. And at the time I was like, what kind of bank? She's like, well, like HSBC or Barclays. Like, what, a retail bank? Can you do that? And this was one of those moments, you know, VCs, when you're looking for investment, will often say, like, why you and why now? And there was this moment where suddenly why now was important, because all of the regulation that had prevented new entrants from coming in was suddenly being drawn away. And now there was this window of opportunity where suddenly you could do something that was mainstream utility-based banking, not messing around at the side like a little credit card play or direct debits, but truly digital banking. It's not suddenly someone lights a fuse and it explodes. The fuse is super long. Like someone lights it and a few years go by and people are like, no, I think this firework's dead. It's definitely not going to, whoa! And suddenly we've got new challenger banks with millions of customers. Or whether it's other changes that seem very subtle at the time that allow us to deliver these real-time, intelligent, contextual services. And that's a fundamentally different model that needs fundamentally different suppliers, different people working on it in a different operating model.
Yeah, I mean, it's reasonably ironic, isn't it? Like, we're at a situation where services are the thing that's really coming forwards, which is ironic given the name financial services, isn't it?
My name's Anne Bowden. I'm CEO and founder of Starling Bank.
My name's Tom Blomfield. I'm the CEO and one of the co-founders here at Monzo Bank.
Rishi Khosla, CEO and co-founder of OakNorth.
I'm Nick Storonsky, CEO and founder of Revolut.
After the financial crisis, it was very clear that customers had lost trust in the banking system, and they were willing to give a try to other alternatives.
Obviously, customer preferences changed and technology changed as well, but that coincided with the effects of the financial crisis.
The launch of the iPhone and the launch of the App Store was the real moment when you started saying, oh my God, this could be a very, very different environment.
So I joined Borders in late 2009. At the time, we had invested in a few companies that would now be called fintech, but the term fintech did not exist. So we were invested in some payments companies, we were invested in Zopa. Then come 2008, the banks stopped lending. Not entirely, but to a large degree. Suddenly demand for Zopa skyrocketed. And so you see this huge surge in demand for the first sort of peer-to-peer lending platforms. And I think we saw that continue with people like Funding Circle, with Market Invoice, these sort of early lending plays in fintech in London. Their growth was really assisted by that, the banks pulling back from lending post-financial crisis.
So when we came together as a team, exploring the idea of launching a new consumer finance business, we were exploring ways to build a business that put the customer right at the front and centre of the business and offered the best value. And in thinking that through, we came to develop what became known as the peer-to-peer lending model, which is now being copied all over the world. So it's quite nice to have been the first in the world and a great British invention that's travelled widely. But the problem we were trying to solve was to create a more efficient business that provided better value to consumers. And if we could use technology along the way to help provide some of that value by cutting costs, but also importantly to provide better service. Well, at its heart, peer-to-peer lending is a really simple idea. It's taking people who have money and giving it to people who want money. At a time when banks were really inefficient. They were big, bloated organisations with enormous cost bases. And somewhere along the way, I mean, they ultimately, at their heart, are doing the same thing. They're taking money from one source, in their case, retail depositors, and transferring it to their borrowers. But they're a very fat, bloated and inefficient middleman in the middle. And we thought we could use technology to do it much better.
The months before I started my first job, there were kind of murmurs in the economy. Northern Rock became bankrupt, and I joined my first job in September 2008, basically as Lehman Brothers collapsed.
Well, to be honest with you, I was just hired by Lehman Brothers, and I thought it's a good opportunity for me to live internationally. And also Barclays bought fixed income division in Lehman Brothers, and then I was in the equity derivatives division, so we were bought by Nomura. So officially I was never out of the job. So for me it was, I would say, a very easy experience compared to some other senior people.
I've been in the financial services industry in banking for 30 odd years. I started as a graduate computer scientist in Lloyd's Bank, and I've had a career at many of the big banks all over the world.
I hadn't really been through a financial crisis as an adult before. And it was, the mid-2000s and the whole of the 2000s really was, I guess from the dot-com boom boom and then bust onwards, was a real time of financial prosperity. And banking was king. It was where people made their money. And then there was just a question, I think, in 2008, and obviously the years that followed were a huge recession. Within weeks of me starting, there were rounds and then round after round of redundancy. We were the cheapest in the building, and so I didn't know who was good or who was bad, and so we were almost immune. But all of the ranks above me up to partner got cut. Yeah, it was really tough, and I think it dented people's confidence. And investment banking was no longer the choice of career for the smartest and the most ambitious.
I got into commercial banking only because I had a bad experience with a commercial bank, and I said I'm going to do something about this. The driver for actually founding it was an experience we had back in 2005, so i.e. before the financial crisis, when we were building Copal. We went to a commercial bank, asked for a line of credit. We were politely told where to go. And a few months later, we went to the institutional desk of one of our clients and were able to raise 100 times the amount of debt from them for fundamentally exactly the same business. So we said to ourselves, we're a commercial bank, wasn't able to lend us 100th of the debt amount, but an institutional player was. There's clearly something wrong here in the way that commercial banks are servicing small and medium-sized businesses, especially those in growth mode. We went back to that problem and sort of identified it as a structural problem which exists across commercial banks around the world fundamentally, just in terms of the amount of time they spend underwriting any one of these deals is so limited, so they haven't got the ability to understand the businesses in the right level of depth that they need to, and therefore generally end up making very computer says no type decisions. So we were of the view that if we were able to actually use larger data sets to actually have much more informed decisions around the businesses, we could actually come up with a much better viewpoint around the risks and therefore their ability to lend to that particular organization.
When the crisis subdued and we got to the next stage, the recovery, and we all started putting our organizations back together again, everybody went back to the way they were before. The bankers forgot what had happened. And when they started talking about their bonuses and about recreating the past, I decided that I had to create a new sort of bank.
I think that the crisis in 2008 and 2009 had a huge force in terms of reminding financial services that the customer needs to be at the center of the proposition. And off the back of that crisis, you had all of these innovators, all these entrepreneurs coming out and saying, there's a niche, there's something for us to fix, and we need to reframe what financial services should actually be about. Let's remember that the customer is the key point, the customer is at the center. What can we do to make the experience better for him or her?
I wanted to be a banker, but I wanted to be proud to be a banker. And that's why I started Starling Bank.
I was always amazed, sitting on an exotic trading desk, how traders were making literally millions of dollars every day trading with each other. And because of my trading background, I can, very quickly, within seconds, calculate numbers in my head. I was always, paying with a card, and then, okay, here I lost $10, here I lost $20, which was a bit frustrating for me. So I started looking into the market to find a solution for myself. I didn't find a solution, or there were solutions, but they were, clunky, not great. And I thought, okay, you know what, it's a good business idea. Maybe I can create something. I have zero knowledge in payments industry. I have zero knowledge in how cards work, how banks work. So I had to learn it and then, come up with a solution and then, offer this solution in the market.
When I was back at Monzo, I'd go out and talk to executive bankers, and they'd have this product grid floating in front of their face, and they'd say kind of, where do you sit? Oh, prepaid card, current account with a little bit of overdraft lending. Like almost everything is seen through that lens, which meant that they were the big players in a commodity product market. New entrants were going to really struggle with doing anything. But then we've got Starling, Revolut, Monzo, suddenly coming to the fore and growing rapidly.
When I started Starling, people told me I was crazy. It was impossible to start a new bank, especially a bank like Starling, a bank based on new technology, a new way of engaging with customers, a bank on your smartphone. People said it couldn't be done.
No, initially I started alone, so I worked alone. Well, I hired a team of 5-6 people, right? We worked like for 9 months, so like it was really tough. So yeah, we had to learn everything.
Starting from scratch on everything can be very, very slow, waste tons of time, and you end up making many of the mistakes that have been made before. And so marrying the two, I think, is the best approach, figuring out what we can learn from how it's been done before, what are the good things, but also being really honest about what are the bad things, and then continually starting from first principles. We started Go Cardless in December of 2000. I think we officially incorporated on the 1st of January 2011. And the problem we were trying to solve, myself, Hiroki and Matt, the three co-founders, was how do we not be management consultants? Very honestly, I think we were all pretty disillusioned with that career. We wanted to be founders. The film The Social Network was the point at which I think it became mainstream and cool to be a founder of a technology company. We didn't know at all that fintech was a thing or that it was going to become a thing at all. We didn't really know that even starting technology companies was actually a viable thing to do as a career, like being really honest. One of my co-founders quit his job. I think he was a Deutsche Bank bond trader in 2005, which was like the heyday of a kind of investment banking, being a trader at the investment banks. He was on a 6-figure salary at the age of 22, and he told his boss he was quitting Deutsche Bank to run a startup, and it was laughed at. I turned down a job at McKinsey to start Go Cardless, and a family friend who'd worked in investment banks for his whole career told me it would be the worst mistake I'd ever made, which in hindsight is funny. Really, the origins of Monzo go back sort of 5 years before it started at Go Cardless. We built these systems to process direct debits, to automate back office kind of invoicing and money management. Direct debit processing for small business, as fascinating as it is, it was not like my life's passion. And so I didn't get up every day excited about direct debit processing, but it did teach me how money moved around and how it actually wasn't as complicated as the banks were often making it. And that was also around the time that the smartphone was getting really big, kind of 2010, 11, 12 was when the kind of iPhone went really mainstream. And you got these really big companies that were entirely smartphone based. It's the early days of Uber and Spotify. And these were apps that somehow seemed to really fit into your life, to make your life more convenient, simpler, cheaper, easier. And that was sort of a light bulb moment. They just really seemed to be focused on you, the customer. And banks didn't seem to do that. And there's this now much higher bar in terms of Citymapper or WhatsApp or Spotify. Like, this is what consumers expect now. The banks aren't providing it. But I guess most people thought that's because banking is complicated or different or hard. And I sort of was able to see through that, I think. And for me, it was a chance to build something that my friends and family would use every day, that I would use every day, that I was interested and passionate about. And I remember very vividly the first time I saw a Monzo card out in the wild at a coffee shop. Now it's every day.
Well, it's been 5 years, and now we have 750,000 customers. We have 50, 60,000 small businesses that bank with us every day. We're growing very, very fast. But what's most important is that people enjoy the experience of banking with Starling. I have been in fintech an awful long time. And when I started in the early 80s, fintech wasn't sexy. Now it is where it's all happening. Fintech is changing people's lives and changing industries.
I think London has this really interesting confluence of a lot of really world-class universities in and around London, the London universities, Oxford and Cambridge, just a real density of incredibly well-educated people. You have government departments and regulators all within about 2 or 3 miles. You have all of the payment schemes in one place. You have the financial centre. You have the press, and then a bunch of investment, all in a single place, which is really the right recipes to create a vibrant community. And so I think in the last 2 or 3 or maybe 4 years, fintech has really started to boom in a way that's quite incredible, actually, especially if you look 10 years back. And it's happened in the US a few times, in Silicon Valley, where you have a particular industry where you get multiple companies that are commanding multiple £billion valuations, attracting billions of pounds or dollars of investment, but never in Europe. That's never happened before now. And I think not just fintech broadly, let's take digital banking. You've got Starling, Monzo, Revolut, OakNorth, N26 and more exceeding £1 billion valuations and attracting hundreds of millions of pounds of investment. It's 5 or 6 companies in one sector in Europe. And that, in my memory at least, that's unprecedented. I think it's a phenomenal thing for society, actually.
I think the interesting thing about London really is that if you look in the inside of the M25, there's all of the different ingredients that are really needed to make, an ecosystem for what we need to do. The talented people, the investment that's coming through, and actually like it's made almost a Galapagos island of fintech, which is an amazing thing.
Oh, I think I'd probably compare it better with like West Coast of the US. So Silicon Valley, you had the sort of West Coast vibe, you had some big universities there, and it kind of brought enough together to start off that startup scene. But fintech's different because it doesn't need HP and Intel. It needs the regulator. It needs a central bank. It needs other banks. It needs asset managers. It needs tech talent and startup. And that was something that I think London has beyond any other city, because it's like saying, let's bring Washington and New York and San Francisco together in one package. And suddenly you get people meeting each other and being able to go from one meeting to another, FCA in the morning, followed by talking to some customers, then some tech talent in Old Street, then a supplier, then BlackRock in the afternoon. And it just creates that ecosystem.
None of us are from London, but we all move to and or spend a lot of time in London to get 11FS off the ground and had followed the career through fintech to get to founding 11FS.
There are great places across the United Kingdom where you can set up a life, where you can drive a business from creation through to a huge amount of success. You can bring in investment and you can really create a thriving economy and a thriving ecosystem there as well.
What we have as a country are 2 enormous advantages: language and time zone. We're the only place in the world that you can do a conference call with people from East Asia and the West Coast that works effectively for everybody. It means that in a world where talent is everywhere, you can operate a business from London in a easy manner than other places in the world.
You really can access the best talent from anywhere in the world in the space of technology, regulation, product build, and so on.
The UK is an incredible talent magnet as well. So some of the most talented people from all over the world, right across Europe, want to build their fintech company in the UK. It is the place where you can succeed and feel very much part of society.
For as long as I've been in the business, which is 30 years now, people have come to London to see what was going on in banking, Africa, Asia, wherever.
So when we're hiring people, obviously skills are really important, but they're not the be-all and the end-all. Another really important facet of hiring people is their cultural fit. And when I say cultural fit, I don't want to imply that means we want everyone to be the same in a very homogeneous group. We want as much diversity of thinking as we can, but we want people to share a common passion that we're doing a good thing and we're doing it in an exciting, vibrant way.
The UK is one of the leading destinations for fintech investment and forecast to overtake San Francisco. And a lot of that is driven by the small number of very large companies. So the Revolut, the Monzo, the TransferWise, the size investments these very big companies are raising. And that will continue. Once you've built a company in London, it's very hard to move the HQ elsewhere. And so when I look at the axes of what we invest in, that team and culture point is really important. And the culture of the company is set from the first 20 employees you hire and how you work with those first 20 employees. It becomes harder and harder to course-correct the further down you've gone. Every company is different, but it's important for that culture to be strong and to make sure you are hiring and retaining great people as a result.
If you're successful, the upside potential for the business is very large, and therefore, actually, from a risk-return perspective, it's a very attractive place to invest. Clearly, for the right propositions with the right management teams, etc.
What we really see is small groups of very determined people achieving
massive impact, often deep in the workings of complex international organizations.
I think fintech is all about this idea of entrepreneurial spirit, because you need to have a huge amount of passion and belief in what you're doing to be able to succeed with a small company or an SME. And so it is very much about wanting to change things for the better and believing in your product and believing in the benefits of bringing your product into the sector.
I think the motivation is not purely to work in a nice brand and earn as much as possible. The motivation is to change the world and to improve the world. And the best place to do that is working in a tech startup. But being an early employee in a great fintech company can make you a millionaire.
And guys, thinking back to when we started, London had a bit of a tech scene when we were getting moving. There was the Google campus, there was the Three Beards and the whole Silicon Roundabout, as it was sort of affectionately known. But then banking really came into it, or at least fintech really came into it when sort of Level 39 opened and things started to happen from there.
Yeah, I think it's the creation of the sort of bridges, isn't it? You know, actually, how can you take those slightly scary scenes of like people in like sneakers and t-shirts type thing and get it as some sort of neutral zone where the bankers can kind of come and, you know, play there and feel comfortable. And I think many of those places have sort of traversed that really, really well.
And they opened Level 39, which is both a place and a metaphor. It's the 39th floor of a building in Canary Wharf. And this sort of became this sort of neutral halfway house between the two. You had sort of surrounded by the bankers, but in there you've got the fintechs, and you've kind of got the government making regular announcements, like the Chancellor of the Exchequer making announcements and sort of legitimizing that space for the bankers. And at one point we even had a little space there.
Well, Level 39's been around for 6 years, and it sits right at the heart of Canary Wharf. And its purpose is really to bring innovation right into the heart of global financial services. And our aim is to make sure that the world's best innovators are as quickly and accurately able to identify and engage with the needs of financial services as possible. We're trying to create conditions, in other words, in which the long-term future of global financial services can be transformed. But we also have some fantastic star companies, notably organizations like Revolut and Digital Shadows, both of which came here as teams of 5 or so and have grown into globally known names.
I remember doing some consulting for the UK government, DIT, Department of International Trade, and I was invited to the launch of the Tech City initiative at the Truman Brewery just down the road here. And I thought, oh, this is bold, this is wonderful. From the new Cameron administration, the Conservative administration at the time, I was asked if I had some ideas about how we might solidify this Tech City initiative. I wrote the Tech City strategy overnight, actually. It was just one of those moments where you just had to just throw it all together. I was invited to present that to various ministers, the DIT, eventually number 10 Downing Street, who then compelled me to actually lead the organisation that I suggested.
And at the start, it was meant to be an organism that would support these fledgling companies back then, who are still very small, with introductions to government, introductions to investors, etc. So this is very much the start of TechNation.
So I think the most challenging thing for the fintech industry over the last few years has been to turn what was an enviable ecosystem of startups into some really good, strong companies, and really companies that we can take to market in the UK, become listed entities, and then actually export around the world. Some cynics were saying that this would never happen. But, you know, from my point of view, there isn't a single startup that is actually an overnight success. From my own perspective, running my own company and advising many other companies, as a minimum, you've got to give them 7 years. But we are coming up to that 7-year period. And it is interesting that we are beginning to see some of these unicorns in private market fundraisers. My hope is that they actually turn into public market listed entities and we can export from there. But I think the latest numbers suggest that already here in London, we are second only to the Bay Area in the US for fintech unicorns. So I'm really excited about where this can go.
I think the introduction of all those startups at that stage just changed the game, really. You know, it wasn't really that the big incumbent organizations were looking out of their giant towers at their competitors and being like, well, so long as we're just slightly better than them, we'll be fine. The aim of the whole industry shifted from just having more customers than your competitors to fundamentally about the creation of digital services that actually customers found compelling. And because of that, really the dynamic of the industry has been altered, I think, you know, honestly forever, because it's no longer about the stacking of consumers, but how sophisticated is your intelligent digital services? And actually, fundamentally, can the things that you've been doing for the last 100 years in terms of the processes or the structure or even the way in which you invest in things carry you to this new world?
And I think the customers look to buy a better version of themselves. And if you help me save, if you help me plan for retirement, if you help me do something that helps me become the person I want to become, that's very different to solving your own problems. And I think banks got very internally focused.
New technology comes along, a bank looks at it and goes, well, this is great because suddenly we can offer the same things we've always been offering, but rather than a piece of paper, we'll now put it on a little black screen. But they don't look at what can this technology truly deliver. You know, if it is real-time, intelligent and contextual, then no longer is it just a better form. It's, well, why use the form in the first place? Why not sort of approach this as a private banker would? Actually, the private banking that Rihanna gets in UBS or wherever she banks, with like 20 people looking after her, that's the kind of level of service that we should be able to offer to everyone. Banks need to be more like great waiters and less like bad landlords. It's that you need to align really with what customers need rather than actually it always being this conflict where you're sitting across the table.
What we've seen in retail banking is a number of new institutions come into the market unencumbered by the legacy problems that the major banks have. Clearly, the way people do banking has changed radically. People are not visiting branches anymore to the same extent. They're not using checks and they're using less cash.
So the financial system has to evolve, and it has started to, whether that be adapting to the change in use of cash, which in the UK has declined from around 60% to below 30%, or whether that means financial services making use of the latest technologies out there.
The threat to big banks is, can they innovate fast enough? They've learned, I think, with the advent of fintech that there are ways to provide better services, ways to make services cheaper, ways to make it easier for people to understand their finances. And that's been a challenge for banks to keep up with, not for lack of trying or because they don't want to, but because sometimes those legacy systems are just hard to change in a way that some of these new systems can be built from the ground up.
So I think challenger banks came along as the regulators started giving out more licenses, but this whole threat that they're going to put us out of business, I think is a little overstated.
You know, we obviously see threats to pieces of our business model as opposed to perceiving a threat to our complete business model.
The centre of gravity in a bank, around which everything revolves, orbits, is not the customer. It is the financial product. It's the balance sheet, it's the mortgage, it's the loan book. And the customer is always secondary to that. And I just think the big banks end up making suboptimal decisions because of that. And so, yes, the financial crisis played a role in kind of creating that trust gap, but I think there are much more systemic issues in banking as a whole.
Well, it's a very good question whether the financial crisis sped up what's happened in fintech. In many respects, of course, it put the banks on the back foot. And one of the things that people do when they're on the back foot is they are more risk and decision averse. So in some respects, and certainly in my own experience, it slowed the course of fintech adoption. But I think, of course, it also created an opportunity for many people to address the trust deficit which had built up with banks. So many consumer-facing fintech businesses have been able to establish a really good brand and reputation and set of relationships with consumers, which the banks are learning from and in some respects trying to catch up with.
Fintechs will be disruptors and will create businesses of tomorrow, but at the same time, parts of those businesses and many of those fintech disruptors will be partnering with banks as banks wake up and say, I can't continue to be left behind, or parts of the value ecosystem that I've left behind, I can no longer do that. So I need to either figure out internally how I'm going to innovate, or I need to partner and collaborate with some of these disruptive fintech businesses to help me evolve my business.
The big banks have got still very high costs in running a branch network. They're competing with new institutions that don't have those costs. But equally, they've got millions and millions of existing customers who tend to stick with those banks unless they get a really bad service. So it's an interesting market, combination of new entrants, but the big banks have had to respond by offering competitive services.
Banks have now either brought in that talent in-house to try and build some of those innovations themselves. They partner with fintechs to bring those innovations to their customers, or in some cases, they acquire the fintechs as a way to get at that technology and that customer service.
There's a question I think that's often asked, which is, will we ever see a fintech supersede a big bank? I'm not quite sure that's the way to frame the question. I think what we're seeing instead is the emergence of a far more mixed ecology.
In the same way that the previous fintech crisis drove and was one of the key ingredients to drive the fintech evolution or fintech revolution, I think it's possible that Brexit will also be a key ingredient that will potentially drive the fintech evolution that we will see.
Regardless of what happens in the future, Brexit, whatever it is, all of those ingredients within London are still here. The talent, the ability to actually create startups in this ecosystem. There's big organizations with some problems still. There's huge amounts of investment that's kind of rolling around. So, in this place, the rules are changing slightly in terms of what might come with Brexit or any other challenge. But fundamentally, the players are still the same.
Suddenly we've got this chaotic and complex marketplace, and that chaos is only increased by things like Brexit and what's happening in politics in general. So we're getting to a point where strategy and the way that you do business is not like some massive chess game where you're trying to work out 30 moves ahead how all this works. It becomes like a sport. Suddenly it's about seeing what happens on the field, orientating yourself to what's happening, working out what that next move is and making the move. And that is startup strategy.
I actually think much of the impact of Brexit is already priced into the market. Certainly I've seen it from the perspective of capital raising at the moment, but there's a lot of uncertainty around Brexit, and quite how it pans out, I think, will crucially affect the fintech sector in the UK. The thing that we have to preserve first and foremost is the access to talent. But whether that talent comes from non-EU or it comes from EU, I think we need to remain open to it and just make sure that we can always access the best talent here in the UK.
I think London and the UK has got underlying strength, the traditional strength on which our success is based, and they remain unaltered despite Brexit. But the most important thing is to have the right kind of talent, and that's why a future migration policy that opens the London and the UK up is very vital.
The other thing that we need to get right is our relationship with the rest of the EU. Many entrepreneurs start businesses here in the UK because it's a stepping stone into a market of more than 500 million people. And at the moment, the financial services regulations work seamlessly across that huge market. So you tell me, how's Brexit going to play out? Well, it depends on what kind of Brexit we actually get.
Nothing's going to change in terms of the fundamentals. Whilst I'm not complacent about Brexit, I remain optimistic that the resilience we've seen over the last 18 months and before that will continue, regardless of the exit path that we determine hopefully very soon.
I think the last 3 years have been really interesting. I think the sort of preparation or, will she, won't she? It's been like some sort of soap opera with Brexit. We're preparing for a zombie apocalypse that we hope will never happen, but might happen. And we're in this weird thing of do we dig this weird big tunnel in our back gardens and stack it full of cans? Or do we just focus on actually being able to run faster than other people? So I think the uncertainty in the market has been really interesting. And one thing we know for sure is that money markets dislike uncertainty. But with all of that said, really, actually we're seeing unprecedented growth. We're seeing unicorns being crowned faster and faster than ever before. We're seeing people doing amazing things in sort of weird and wonderful parts of financial services, whether it's, making back office interesting things, or whether it's, customer facing B2C propositions. But fundamentally, I think we're really early in this cycle. We talk about 1% finished a lot. Really, fintech is 1% finished. The journey that we're on that has got us to today has been long, but fundamentally the opportunities ahead of the industry is much, much more to go.
Ultimately, money underlies a lot of what goes on in our life. And I don't know about you, but when I get into an Uber, I don't get my card out anymore. Amazon have stores where you go in and just take stuff. And when you've got those kinds of end-to-end journeys, where it's not about the financial product and the financial organization, but that financial piece just fits in with everything else, then you suddenly see that we don't have these ivory towers, these siloed financial services organizations. It integrates into everything.
And then across boundaries as well, we've seen the investment into the UK post-financial crisis, post-Brexit, is coming more globally as well.
It's taken nearly 1,000 years to build the City of London to what it is, and I think we can look forward to continuing to play a part in what has been the most incredible driver of human progress for nearly a millennium.
This has happened throughout history where we see different financial booms and busts, but I think we're much better equipped to spot risks before they become problems and to address them if and when they do.
This is a very, very, very fast-changing game. Yesterday's model is not going to be fit for purpose. That's for sure.
There is a huge amount to go for in the future. And I'm really excited to see how open banking in particular plays out, because that enabling technology can really become a catalyst for further innovation, further competition. And I think the fintechs are going to be first in line to take advantage of that.
We'll be able to see fintech players anticipating needs of consumers, providing bespoke solutions in a way that perhaps we as individuals wouldn't determine ourselves if left to our own devices.
I think in 11 years' time, we will look at the tech sector and say it is the largest part of the British economy.
I've been now focusing most recently on what's called frontier technologies, things like blockchain, AI, IoT, and robotics.
I would keep an eye on where digital assets are going, because this is the next best opportunity to really transform the whole of the financial system and create a financial system that's broadly giving better and greater access to everyone.
I think the consumer appetite has really changed. The meaning of trust has really changed.
We will become more valid competitors at scale.
I think the next stage is invisible banking, which happens around us. The future could be very, very different.
What trust used to mean pre-financial crisis and what trust means now, and authenticity, I think that's really, really big.
Our ultimate goal is that there is no more fintech, and it just is financial services, and the customer is at the heart of what financial services is.
Having seen the success of what the UK did with fintech, you're now seeing other regulators around the world start to look to replicate that. So we're just getting started.
I think we will just become the banks of the future, and then in 10 or 15 years there'll be a bunch of new folks coming along saying we're going to disrupt the big banks like Monzo. And it'll all start again.
Yeah, I was building on the lecture versus coming daily under pressure, working on the plot and the scheme. The true stock trademark is at the edge of your dreams. I'm talking one shot for the kill. The breeze cut, freeze up, straight dropping the chills. I'm talking taking over pieces and shares. A bomb race sky high, check the movement is here, yeah. It's one art, one shot, now the future is yours, go. Yeah. It's one art, one shot, now the future is yours, go. It's one art, one shot. I'm turning dreams into reality. In the lab with the formula and chemistry. The memories spark and motivate and make the industry shake. We put the bars in the brakes. I'm talking one chance at best, yes. Painting pictures for the culture, keep the brushes fresh. Flip the color, work the drummer, passion never rests. Freedom is a teacher under pressure, now we blessed. See, I was so go for the goal. It's one art, one shot, now the future is yours, go. Yeah. It's one art, one shot, now the future is yours, go!